a VAT registered person constitutes a
60% of its investment in the FU on 1st of April
failure to register
for shillings
or
47
failure to deregister for
million
VAT.
when the fair value of identifiable net asset of the FU was
an offense related to
50 million.
Records.
The fair value of the remaining
failure to keep, retain,
40%
and also
equity
to
interest was
maintain proper
4,300
records.
million at
Failure
disposal. Pareto Limited has not accounted
keep,
for the disposal. And then number
retain,
5, you're told none of the companies have issued any shares since Pareto Limited acquired.
Then you are also required to retain the records that you are keeping.
And number 6, you are told neither the goodwill on acquisition of subsidiaries nor investment in associate, that is, had been impaired. So from that information, what you're required to do, number 1, is we compute the goodwill arising on acquisition of the investment in the subsidiaries. Number 2, to compute the gain or loss arising on disposal of the investment in the FU as reported
transactions
1,
such as sales,
the individual
purchases,
financial statement
invoices,
of Pareto,
credit notes,
2,
and even debit notes for
of profit
the
or loss.
prescribed
And finally, part
period.
C of that question, we are required
And the period is generally 5
the
years
consolidated
for
statement
VAT
of financial
records.
position as at that year
That
of June
includes
2021.
deliberately
So these are
preparing
questions
or
for group
maintaining
account.
false documents.
And as usual, what
That
we
is
need
the
to do first
offense.
of all is to
And
come
the
up with a
penalty
group
is
structure.
10%
Then we go through
of
the
the
additional
amount of tax
information.
payable, subject to
We
a
see whether
minimum
there are
of
workings which we
100,000
need to do,
shillings.
and then from
And
there
if
we
there is
prepare
no tax
basically we
payable,
compute
the penalty
what
is
is required. So
100,000
therefore,
shillings.
let's first of all we come up with the group structure here,
3.
which will be working 1.
Filing
Group structure.
VAT returns.
A group structure.
Late filing of
where do we get that particular information about
returns?
The group
Late filing
structure
of VAT returns.
So that information we have it from the additional information number 1, whereby we are told on 1st of October 2020, Pareto Limited acquired 80% equity interest in the company which is called PABA Limited on 1st of October 2020. 1st of October 2020, and also we are given the retained earnings of PABA on that date. That one will be used in the computation of goodwill, including the purchase consideration. That one will be used in the computation of goodwill. But let first of all we go to the additional information number 3, whereby we are told PABA Limited, not PABA but rather Pareto Limited had acquired 100% equity interest. 100% equity interest in the company which is called DAFU Limited a number of years ago. So in this case, we are not given the specific date of acquisition, but we are told Pareto Limited had acquired 100% shareholding in DAFU sometime back, or basically a number of years ago. So basically what that means is that from this group structure here, Pareto Limited, this will be the parent company, and automatically the parent company is the one which is supposed to prepare the group account. Then PABA is a subsidiary, and also DAFU here is a fully owned subsidiary, fully owned means that the parent company acquired all the shares or hold all the shares in that particular subsidiary. So we have that information, but also before we go maybe back to note number 1, there is another information which is given and which is very, very important in note number 4, sorry, where we are told Pareto Limited disposed of 60% of its investment in DAFU on 1st of April 2021. So that is the information about disposal of interest. Disposal of interest. Disposal of interest, whereby we are told Pareto Limited disposed 60% shareholding in what? In DAFU. So we have disposal of interest in DAFU Limited. So, and automatically this particular disposal of interest, these usually take place during the current financial year. Now, first of all, if we go to the information we have at the paragraph 3 up there, so the current financial year was or ended on 31st of or that is June 2021. So basically what that means is that this year started on 1st of July 2020. But now if we go back to the information we have in note number 4, we are told Pareto Limited disposed 60% of its investment in Darfur during the current year. So that is the 1st of April 2021. 1st of April 2021. So how many months do we have here to the date of consolidation? We have April, May, June. So here we have 3 months, and automatically here we have what? 9 months. So what that means is that for the first 6 months, this particular company here, that is Darfur, this was a subsidiary, because you can see in the first 9 months, the parent company had 100% shareholding. But on this date, we are told the parent company disposed 60% of its shareholding in Darfur. So that what that means is that the parent company retained 40% shareholding in Darfur, and therefore Darfur in the last 3 months was an associate. And therefore, if for example in this particular question here the examiner was requiring the candidate to prepare the consolidated income statement, it's very, very important to note that this company here, that is Darfur, for the first 9 months you treat it as a subsidiary, meaning that you take into account its revenue and expenses for the first 9 months, for the first 9 months, and then you add that to the revenue and expenses of the parent and the revenue and expenses of what? Of PABA. But in the last 3 months, that is, Darfur Limited will be an associate, and therefore what you need to include in the consolidated income statement is the parent company share of Darfur Limited profit after tax in the last 3 months. And also in this case, because the parent company lost the control, you have to determine the gain or loss on disposal, which then you recognize in the income statement as part of the profit or loss. But in our case, if you check on what the examiner was requiring here, specifically in part C, we are only required to prepare the consolidated statement of profit, the consolidated statement of financial position. So what that means is that in preparing that, we check the status, we determine the status of Darfur at the end of the year. Darfur Limited at the end of the year will be an associate, and therefore in preparing the consolidated statement of financial position, we are going to add similar items of asset and liabilities, those of Pareto, the parent, and those of PABA, but we are not going to take into account the asset and liabilities of Darfur because it's an associate. So what we are going to do is we are going to determine something called the investment in associate, and basically that is the only item we are going to include in the consolidated statement of financial position as far as Darfur Limited is concerned. See, yes, that is why the group structure here is important. But before you do that, maybe you can just go through this additional information again. We see whether there are some workings which are required. Note number 1, we go back to note number 1. We are given information about the acquisition of PABA, and actually the retained earnings, the purchase consideration, all that will be used in the computation of goodwill, which you are required to compute as per part 1 of that question. And also we are told that at the date of acquisition, PABA Limited, or at the acquisition of PABA, the only adjustment required to the identifiable net asset of PABA was a LAD with a carrying value of 625 million less than the fair value. So basically what that means is that this company on the date of acquisition devalued the asset, and remember that process we refer to it as the fair value adjustment or the fair value exercise. So this is by PABA Limited, and the asset it devalued was LAD, and we are told that this LAD had a carrying amount of its carrying amount was 625 million less than the fair value. So in this case, the carrying amount was less than the fair value with an amount of 625 million. In other terms, we can say that the fair value, we start with the fair value, was greater or was more than the carrying amount with 625. So automatically what is this? This is a revaluation gain. And this particular revaluation gain which occurred on the date of acquisition automatically was not accounted for by PABA. So therefore, in preparing the consolidated statement of financial position, this one we add it to the group PP, and number 2, this one we treat it as a pre-acquisition revaluation reserve, pre-acquisition revaluation reserve. In computing the goodwill on acquisition, that will be one of the component of the net worth asset of PABA Limited. So I think we have that particular information there. And then it is also important to note that this particular asset here, that is LAD, this is not a depreciable asset. LAD is not depreciated, and therefore in this case, no depreciation other charge. No depreciation other charge to be computed here, simply because LAD is not depreciable what asset. But if this was a depreciable asset, we needed to compute the depreciation other charge. So let's move to, but we will still come back to that particular point, specifically in answering part A of that question when computing the goodwill. So in number 2 is about information regarding the computation of goodwill. We will still use that in answering part A. And then part additional information number 3, we are given information about the acquisition of Pareto, where we are told the parent company, that is the acquisition of Dafu, whereby we are told Pareto Limited had acquired 100% shareholding in Dafu some time back. We are given it retained earnings there, and also the fair value of identifiable assets, which we are told equal to the year carrying amount. So mean that at the date of acquisition, this company revalued the asset, and the fair value of identifiable asset was equal to carrying amount. There was no revaluation gain or loss. And then you're given the purchase consideration, which was 5750. All that information, we're going to use it in answering part A, specifically in computing the goodwill. And then we're given information number 4 about the disposal of some disposal of interest in Dafu. And also this one, we're going to use it in answering part B of that particular question. And then we have note 5. Note 6. I think no working which is required here. So I think we can go straight to part A of that particular question. Part A of the question. So what you are required to do is to compute the goodwill arising on acquisition of investment in subsidiaries. Investment in subsidiaries. So we start by computing the goodwill arising on acquisition of the first subsidiary here, that is PABA. So let's start by computing the goodwill arising on acquisition of investment in PABA Limited. Equally, remember, as per the information which are given in note number 2, we are computing the goodwill using the full goodwill method. That's the first thing you need to appreciate, or basically to note. So how do we compute the goodwill using the full goodwill method? Number 1, we take the cost of investment. So how much purchase consideration was paid by the parent company in acquiring the shares of PABA? So that information, we have it in the balance sheet or in the statement of financial position of Pareto, specifically at the non-current asset. We are given the amount invested by Pareto in PABA, which is 8,500. So to this, then we add the NCI at fair value, because you're using the full goodwill method. So this figure is also given in note number 2. Additional information number 2, the last sentence, we are told at the date of acquisition of PABA, the non-controlling interest had a fair value of 21.25. So we add the 2. So this will give us 25, 10, 6, 10, 6. So let's confirm whether that is correct. So we have 85 plus 2125, so which will give us 10,625. That is correct. So then from there we proceed and we less fair value of net assets, acquired. So how do we compute this one? Because it's not given, so we have to determine the fair value of a net asset of PABA on the date it was acquired, and we determine that by taking the ordinary share capital of PABA plus pre-acquisition reserves. So therefore, where do we get this? Let's go back to the statement of financial position of PABA, specifically under equity. So under equity, number one, we are given the ordinary share capital of PABA. The ordinary share capital of PABA is a figure of 25. Still, in that case, we also have a share premium. Share premium of a subsidiary company, unless told otherwise, is always taken to be a pre-acquisition. Then the retained earnings, which we have there of 5250, that is at the end of the current year. That is not what we're interested with. We're interested with the retained earnings of PABA on the date it was acquired. And that is now what we refer as the pre-acquisition retained earnings. So that one is given in the addition information number 1, whereby we are told when PABA Limited was acquired, its retained earnings stood at 35. And then to this, other than taking now the items in the statement of financial position specifically under equity, you also have to check whether this company revalued its asset on the date of acquisition. In case it revalued its asset, was there a revaluation gain or loss? So like in our case, remember here, PABA Limited revalued land with an amount of what? 625. This one we have said is a pre-acquisition revaluation reserve. A pre-acquisition revaluation reserve, which is 625. Yes, I think that's what we have. And basically what we need to do here, we get now the total. So we have 25 plus 1,000 plus 35 plus 625. So this will give us 7625. And because we are using the full goodwill method, we take 100% of this. 100% of this will be 62, that is 7625. We less it from the figure up there. We less it from 10,625, which will give us goodwill on acquisition of what? Over 3,000. So that is the goodwill on acquisition. And remember that is a full goodwill. Basically the goodwill determined using the full goodwill goodwill method. So basically that is what is required there, and basically the items which are marked in such a case are those items which we have there. Then we need to proceed and compute the goodwill on acquisition of the other subsidiary, that is the full goodwill on acquisition of goodwill on acquisition of Dafu Limited. Dafu Limited. So we need to have two columns here, and even before you compute now the goodwill on acquisition of Dafu, it is very, very important for you to note that in Dafu there is no NCI here. There is no NCI because you can see that the parent company acquired all the shares, acquired 100% of the shares issued by what? By Dafu. So therefore in Dafu we don't have what? NCI. And that's why you can see, despite the group using the partial goodwill method, the full goodwill method in computation of goodwill, we are not given the NCI at fair value in Dafu, simply because there is no NCI. So therefore what we do here, we take the cost of investment, the purchase consideration paid by the parent company, that is Pareto in acquiring shares of Dafu. That one is given in the statement of financial position of Pareto under the non-current asset, which is 50 750, and then in this case we should add the NCI at fair value, which you are saying is 0 because we don't have NCI. We don't have NCI. We get 5750, and then to this we proceed with less fair value of net assets acquired. Equally, to compute this, we take the ordinary share capital of Darfur plus pre-acquisition reserves plus the reserves it was having on the date it was acquired. So where do we get that? Let's first of all we go to the statement of financial position of Darfur, specifically at the equity section. So the ordinary share capital of Darfur is 2,000. Also, Darfur had a share premium of 500 or 500. And then the retained earnings in the statement of financial position of Darfur 5750 is at the end of the current year, but that is not what we're interested with. We're interested with the retained earnings of Darfur on the date it was acquired, and that is given in the additional information number 3. Pareto Limited acquired 100% equity interest in Darfur a number of years ago when it retained earnings. Earnings stood at 1750. And also you check whether Darfur Limited revalued its assets. So basically, as per the information which are given in note number 3, this company revalued its asset, but you are told their fair value was the same with the carrying amount. There was no revaluation gain or loss. So what we do, we get the total here, and then we less that from the figure we have down there. So we have 2,000, which will give us 2,500 plus 1,750. So which will give us 4,250, and then we take 100% of this. 4,250. We less it from this figure minus 5750. 5750, which now will give us a goodwill of that, which will give us goodwill of 1,500. So basically that also what was required there, and automatically the items to be marked there include what we have there, that and that. And basically by computing the goodwill on acquisition of the 2 subsidiaries, the marks allocated there were 4. So let's move to part B of that particular question. Part B, we are required to compute the gain or the loss on disposal of investment in Darfur. Investment in Darfur Limited. Darfur Limited, Roman 1, as it was reported in the individual financial statement of Pareto. As it was reported in the individual financial statement of Pareto. Now, in this case, when Pareto Limited basically invests, or the parent company invests in a subsidiary, to the parent company, that investment in a subsidiary is like an asset. And therefore, once the parent company sells some of the shares, or basically all the shares in a subsidiary, the parent company in its individual financial statement, not in the group account, in its individual financial statement, it will need to recognize the gain or the loss on disposal. Now, that gain or loss on disposal is computed by taking the sales proceeds. The sales proceeds is basically the amount of money which was received by the parent company after selling some of the shares or all the shares in the subsidiary, minus the carrying amount of investment disposed. Investment disposed, or basically investment sold. And this one is very simple because all these figures are given. So let's go to the additional information number 4, and you're told Pareto Limited disposed 60% investment in Darfur on 1st of April 2021 for 4,700. So that 4,700 is the sales proceeds, the amount of money received. Yes, and then to this, what we know is that the amount of money which Pareto Limited had invested in Darfur is 5750, which is given in the balance sheet of Pareto. The amount invested in Darfur was 5750. In the statement of financial position of Pareto and current asset, the amount invested in Darfur 5750. But in our case, we know the parent company only disposed 60% of that. So that is the carrying amount of the investment sold. So that's how we compute the gain or loss to be recognized in the individual financial statement of Pareto. So this will give us what? 60%, 5750. We less that from 4,700. So this will give us 12 what? 1200. 1200, and basically that is a gain. That is what? That is a gain. That is a gain. So basically by doing that, the candidate here were allocated how many marks? Were allocated 2 marks. 2 marks for computing that. You can see that was quite straightforward. Also in part B, we are required to compute the gain or loss to be or as it will appear in the group account, as it will appear in the consolidated statement of profit or loss. So this is now the gain or loss to be recognized in the group account. So this is something we discussed in our previous session, how to compute the gain or loss arising from disposal of interest. So in terms of how we compute figures here, number one, we take the fair value of consideration which was received. How much amount did the parent company receive after selling the 60% stake or interest in Darfur? So that figure, we already have it in note number, addition information number 4, and which was 47. And then to this, we add the fair value of investment retained. Fair value of investment which was retained. Still, we have that in note number 4 as a figure of 4,300. The fair value of the 40% equity interest which was retained was 43. After adding those two figures, we proceed and we less two items. Number one, we less the parent company unimpaired goodwill. Parent company unimpaired goodwill, and that is something we have already computed here. The goodwill arising on acquisition of Darfur, this figure here. And we also have to note that this particular goodwill here, despite computing it using the full goodwill method, this is a goodwill attributable to the parent company, because in this Darfur we don't have NCI. Because generally here what we take into account is the parent company goodwill which is not yet impaired. So this goodwill was not impaired as per the information given in note number 6, and the full amount is the goodwill attributable to the parent company. So that is what we less there. And then we also less the fair value of net assets at date of disposal. At date of disposal. So what was the fair value of Darfur Limited net asset on the date of disposal? That information, we also have it in note number 4. We are told on 1st of April 2021, the fair value of identifiable net asset of Darfur was 6250. Or 6250. So that's how we determine the gain or loss on disposal to appear in the consolidated, or to be recognized in the consolidated statement of profit or loss. So we have 47 plus 4,700 plus 4,300 minus 15 minus 6250. Is that will give us 1250, which is a positive figure, and that is the gain on disposal. The gain on disposal. The gain on disposal. And actually, that what was required in that part there, and basically by doing this, the marks allocated there were 2. So these are the items automatically which were marked. So let's move to part C of that particular question, whereby we are required to prepare now the consolidated statement of financial position, which you have said is simple, because what we need to do is to appreciate the fact that this will be a subsidiary at the end of the year, and then DAFU Limited at the end of the year, it will be an associate. It will be an associate. So therefore, in preparing a consolidated statement of financial position, we combine similar items of asset and liabilities, those of the parent and those of the subsidiary. And then for DAFU, we just compute something called the investment in what? In associate. So therefore, let's do that. Part C. So the name of the group here will be is a Pareto group. This is a consolidated statement of financial position as at 30th of June 2021. 30th of June 2021. So here we just need to have a single column, and our figures are in thousands of shillings, in million of shillings. So we start with the non-current assets. So first of all, we have the PP. So of PP, we are taking the PP of the parent, recall that, of the parent, that of PABA. We are not including those of DAFU. DAFU is an associate. We don't consolidate asset and liabilities of an associate with those of the parent. What we include here, as far as the associate is concerned, is something called the investment in associate. So therefore, we are only adding the PP of Pareto and those of PABA. We have 4,900 plus 9250, and then we check whether we have any consolidation adjustment affecting the PP. Do we have any consolidation adjustment? Yes, this one. On the date of acquisition, PABA Limited revalued its asset upward with an amount of 625, which was not accounted for. So we add that here, 625. So remember, we don't have any depreciation other charge, which would have been deducted there. So then below the PP, we'd have investment in PABA, investment in DAFU. So those investment, we don't include them here, but as far as PABA Limited is concerned, which will be a subsidiary at the end of the year, we include its goodwill here. So the goodwill on acquisition of PABA is 3,000. And then for DAFU at the end of the year, remember, it will be an associate. So what we include here as far as the associate is concerned is investment in associate or investment in DAFU Limited. So in our previous session, we looked on how to compute this, and actually we said to compute investment in associate, we take the investment, that is, we take the fair value of the investment which has been retained. So which is what you are given here, 43. And then to this, what we add is the group share of the post-acquisition net asset in that DAFU. So how do we get the group share or the parent company share of the post-acquisition net asset in DAFU? So what we do is that we take the net asset of DAFU at the end of the year, and basically by now we know that the net asset of a subsidiary is always equal to equity, share capital and reserves. So what is the equity of DAFU at the end of the year from its statement of financial position? You can either take the asset minus liabilities, or you just take equity. The total equity of DAFU, which is the same with the net assets, is 8250. This is the net asset of DAFU at the end. But now the date DAFU Limited became a subsidiary, became an associate, sorry, its net asset, you have to recall in note number 4, we were given as a figure of 6250. So therefore, whatever the difference here is the post-acquisition net assets. So we get the parent company share of this, which will be 40%. Which will be 40%. So this will give us a difference of 2,000, 40% of 2,000, 40% of 2,000. This one is 800. We add it to this, which will give us 5,100. So that is now the investment in what? Investment in DAFU, which you are saying will be included here as an item of non-current asset. Okay, so then below that we also have the financial assets. Financial asset, no adjustment for this. We just take the financial asset of the parent, 31, plus those of the subsidiary, 28. This will give us 59. And then from there we have the current asset. Actually, for current asset, we are given the total, 3850 plus 4425. Do we have any adjustment to the current asset? We check for things for like intercompany debts. We don't have. Things like unreleased profit, we don't have. So mean that no adjustment for this. So what we just need to do, we get the final figure. We get the final figure. We have 3850 plus 4425, which will give us 8275. We get the total assets. The total assets. So let's first of all we compute the figure for PP there. We have 14,900. There is something we have forgotten here before we add here. So this particular purchase consideration which was received, that is a figure for 47. This amount was not yet accounted for. So therefore is amount receivable. It was not yet paid. So we also included as part of the current asset. We also included as part of the current what? Asset before we get the final figure there for PP. So let's add 47, 82. 75, 8275 plus the purchase consideration received, this one, which will give us 12,975. Okay, so we get the final figure for PP. We have 49 plus 9250 plus 625. Which will give us 24, that is 24,775. Yes, and then we can add all these figures now, plus 3,000 plus 51 plus 59 plus 12,975. So that will give us a total of 51,750. So these are total assets. So we proceed, record equity. So for equity, we record the ordinary share capital, that of the parent company only, which is the 10,000. The share premium for the parent company only. For the parent company only, 5,000. 5,000. Then from there, we will compute the group retained earnings. This one we computed as the last item. And then we will get the total equity. Total equity, we proceed and compute the non-controlling interest. And the non-controlling interest here will only be computed as far as we are going to compute this for PABA. PABA is the one which was 35 for the parent, and that for PABA, no adjustment here. So we get a total of 14,500. And then we have the current liabilities. Current liabilities, we have 47,75 plus what? Plus 17,25. We don't have any adjustment there. We get total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So let's first of all we add these particular figures here. For current liabilities, we have 47,75 plus 17,25, which will give us 65. And then for the non-controlling interest, this one we can compute it directly because the group policy here is to measure NCI at fair value. So when that is the case, then the computation of NCI is quite simple, because what we do, we take the NCI at fair value on the date of acquisition, which is 21/25, plus now the group share of what? The group share of post acquisition adjusted retained earnings. So the retained earnings of Paba Limited after it was acquired, how do we get that? We take its retained earnings at the end of the year. The retained earnings of Paba at the end of the year in the statement of financial position is 50.